A crazy story just happened in South Korea. Around 350,000 investment accounts were forcibly liquidated by brokers in a matter of days. And these investors weren't betting on some obscure penny stock. They were investing in super successful stocks connected to AI, especially chip makers and memory stocks. These stocks had gone up hundreds of percent based on excellent business results. And just weeks earlier, they seemed almost impossible to lose money on. And then everything changed. Prices started to fall. And eventually, brokers began selling these investments without the investors' permission. But here's the strange part. Even if these stocks temporarily fell 40%, these investors should simply have been down 40% for a while. So how does a normal market correction end with investors' account being completely wiped out? And what has to happen before your broker is even allowed to do that? I will show you exactly how this happened and explain how to avoid something similar happening to you. But here is one more thing in this story that matters even more. Because these investors didn't just lose the money they have invested. Over the long run, their real loss could be 5 or even 10 times bigger. And this number is the reason I have one specific investing rule I will not break, no matter how good an opportunity looks like. First, we need to understand what actually happened to these Korean investors. Now, let's go back a year to September 2025. That was the beginning of a very, very big up move for AI stocks in South Korea and also all around the world. So, for example, here is a chart of Samsung, then you have SK Hynix, and also the entire KOSPI index, this is the South Korean stock index, went up quite a lot, For example, let's go to SK Hynix. And here you can see that this stock started to skyrocket back then. So it went from 200 to 300, then it went to 400, it went to 500, 600, even 1,000. And at that point, everybody thought, this move cannot end. Day after day, these stocks were just going up and up and up. And you started to think, I'm stupid not to participate in this rally. This is basically free money. Every day these stocks went up 10%, 5%, 10%, 5%, and so on. So you cannot lose money by investing in these companies. And then the stock market went even further. This stock went to 2,000 and even to 3,000. Here, and this was the moment when people started to think, I'm stupid that I'm only investing my own money in these stocks. My broker can borrow me some additional funds and I can basically use leverage or margin. So leverage or margin means that your broker also borrows some money to you and you can invest a larger amount of money so you can amplify your gains. And a lot of investors were doing precisely that. And that is also the real reason why South Koreans stopped dating. So it was not because of unaffordable housing or mandatory service. It was basically because everybody was investing in AI stocks. Okay. Now let's go back to the chart. But then the unthinkable, at least for these investors, started to happen. And the music stopped and this market went down sharply. So this stock, for example, went from almost 3,000 to 1,400. That's a 40% drop. And for investors who only use their own money without leverage, that was not a problem. They were just down temporarily. But for 350,000 investors who used leverage, the story ended quite differently. And for them, a perfectly normal 40% correction turned into a disaster. And now let me show you exactly how that happened and how you can avoid something like this happening to you. Now let's take one Korean investor. We will name him Mr. Kim, and his nickname is To the Moon Kim, of course. And let's take a look at what happened to him. Now let's say that he starts with 25K, okay, 25,000 of his own money. And then he starts to use leverage. Okay, he borrows 50K from his broker. This is basically 1-to-3 leverage. Okay, not a big leverage, just a normal leverage that he can start using with his broker. And now, what happens if the stock goes up 20%? Okay, so the stock goes up 20% and his account, so this means on the entire amount of money, on 75K, this is 15K. Okay, so the stock went up 15K, 20%. And if you take a look at only his money, this would mean 60% up move on his own money. Okay, because 15,000 is basically 60% of 25K. And at that moment, he starts to think, I'm not Warren Buffett anymore. I'm not Warren Buffett. But Warren Buffett should be following me because I'm so good. But of course, this only works when the stocks go up. The opposite happens when the stock goes down. So, for example, what happened in the Korean market is that the stocks went down 40%. And all of a sudden, this creates all sorts of problems. Why? Because all of a sudden, he was basically down 30K. Okay, 30K. This means that he used all of his own money and he was temporarily 5K in minus. The stock fell 40% and Mr. Kim lost more than 100% of his own money. And this is the dangerous thing about leverage. With 1 versus 3 leverage, a fall of only around 33% is enough to wipe out all of your own money. And the 40% fall can leave you with nothing, and potentially even owing money to your broker. But in reality, the broker didn't wait until Mr. Kim got to this point. Much earlier, he of course received something called a margin call. This means that the broker sent him an email saying, you need to put some additional money into your account to keep your positions open. And if he cannot put more money into his account, or if he is a bit too late doing it, the broker can start selling his stocks automatically. And that is exactly what happened to Mr. Kim, to the Moon Kim. A normal market correction completely destroyed him. And just like that, To the Moon Kim became Back to Earth Kim. That is forced liquidation by broker. And that is what happened not only to Mr. Kim, but to hundreds of thousands of leverage accounts in South Korea. Now, if you find this video valuable, subscribe to my channel. The subscribe button is just below the video. It has been scientifically proven that my subscribers sleep better at night and also enjoy better long-term returns. So subscribe now. But the mechanics are not the most tragic part of this story, because these investors didn't just lose what was in the account. And once you see the real number, it changes how you think about every risk you take. Now, let me show you something that I think is even more important. Imagine that because of leverage, Mr. Kim lost $25,000. And you might think, okay, he made a terrible mistake and lost $25,000. But he didn't really lose $25,000. He lost the future value of that $25,000. So let's assume that money could have grown by an average of 10% per year over the long run. And I'm using 10% simply to illustrate the power of compounding, and also 10% annually is also historical average for stocks. Now, think about it. An investor who loses $25,000 today might not just be destroying $25,000 of wealth. Let's take a look. Let's open a compound interest calculator. And as you can see here, if you have 25,000 in your account, and if you grow this money for 15 years, and your average interest rate or average growth of your portfolio is 10%, so this means, of course, every year will be different. Some years will be negative, some years will be positive, but this is just average, and if you calculate this, you see that this is $104,000. Okay, so the future value of this loss is more than $100,000. And if we go 30 years into the future, okay, this 25K, and if you use 30 years of growth and 10% average annual growth, you can see that the lost money is more than 400,000. So the real loss is much bigger than your original invested amount, okay? Because you need to account for the future value of this money. Now, if you know someone who is using leverage, share this video with them. It might save them hundreds of thousands of euros or dollars. And that brings us to the two big mistakes these Korean investors made. And the second one is the one almost nobody thinks of as a mistake at all. Now, the first one should be obvious. They used leverage. And leverage is especially dangerous because it changes the nature of investing. If you buy a good stock with your own money, and if this stock falls 30%, you have choices. You can hold, you can buy more, you can wait for 5 years. Nobody can force you to sell. But if you buy the stock using borrowed money or leverage, suddenly someone else has a say in what you do. That is your broker. And that completely changes the situation. Without leverage, a crash can be painful. With leverage, a crash can destroy you. And there is another psychological problem. Leverage normally looks safest just before it becomes most dangerous. Just think about it. When are people most likely to borrow money to invest? After the market has been falling for years and everybody is scared and terrified? Usually not. They do it after markets have been going up and up and up. Their friends made a lot of money, their taxi driver made a lot of money, and everybody feels confident. And they start thinking, if I'm making this much with my own money, with 25K, imagine what I could do with 50K or 75K. And that brings us to mistake number 2. Korean investors were buying AI stocks, some of the hottest investments in the world. And the problem was not AI itself, okay? The problem was that everybody wanted to own the same thing. And these stocks kept going up. Now, everybody owned them, and sooner or later, you start thinking, I'm missing out, I should start investing, or I should put more money into these investments. And this confidence becomes overconfidence. People start taking more risk. Some even start using leverage, just like it happened in South Korea. And this is where things become more dangerous. In investing, the more expensive something gets, the more people seem to want it. Just try running a supermarket like that. And then eventually the market turns, the music stops, and investors who bought at the top start to sell with huge losses. And this is exactly why doing less usually makes you richer in investing. The investors who constantly chase what is hot usually hurt themselves. I showed the evidence behind this in my video, The Less You Do, the Richer You Get, which I'll link below. So, what is the biggest lesson from South Korea? It isn't don't invest in AI. It isn't don't invest in semiconductor companies. And it certainly isn't the stock market is dangerous. The real lesson is this. A great investment can become a terrible investment if you invest in it the wrong way. There are always 2 questions you should ask. The first question gets almost all the attention. Which stocks should I buy? Which ETF? AI, Bitcoin, gold, S&P 500? But the second question is often even more important. How much am I investing? Am I diversified? Am I using borrowed money? What happens if this investment falls 30, 40, or 50%? Can I survive that? Can I still sleep at night? And most importantly, can I stay invested? Because your goal as an investor should not be to get rich quickly as possible. Your goal should be to build wealth without getting wiped out along the way. So my key rule is very simple. Invest only your own money. Don't use leverage. Don't allow one investment or one exciting team to determine your entire financial future. And when everybody becomes euphoric about the same investment, become more careful, not less. Because investing is not a sprint. You are playing a game that can last 20, 30, 40, or even 50 years. And because of compounding, staying in the game is incredibly powerful. What happened in South Korea is an extreme example, but the mistakes behind it are incredibly common. Investors chase what is hot, they become overconfident, and then they take too much risk. Now, to wrap up, if you want to learn how I personally approach long-term investing, how I select investments, and how I manage my 7-figure portfolio, I explain my complete approach in my free investing masterclass. Join by using the link in the description below. And remember, making money is important, but first you have to make sure you stay in the game long enough to enjoy it. See you in the next video.